For business expenses, the IRS starts with a simple question. Are you carrying on a trade or business to make a profit? If yes, many costs can be deducted, but not all. Some costs are too long-term, so you don't deduct them now. You capitalize them and recover the cost later through depreciation or amortization. On the EA exam, they love mixing these ideas in one fact pattern. To be currently deductible, a business expense has to pass the core test. It must be both ordinary and necessary. Miss either one, and you're done. Ordinary is about the industry. Is it common and accepted for that type of business? If it's weird, personal, or a one-off stunt, it's a red flag, even if it might help the business. Ordinary doesn't mean happens every day. It means the expense fits the norms of that trade or business. Think, a landscaper buying mulch, a CPA paying for tax software, a restaurant buying food inventory. The exam angle is usually, does this look like a business type cost for that industry? Or is it really personal dressed up as business? Necessary is a different idea. Necessary means helpful and appropriate for the business. Here's the trap. It does not have to be indispensable. So if a cost reasonably supports the business, like advertising, professional dues, or a business phone line, it can be necessary even if the business could survive without it. On the EA exam, watch for answers that wrongly require essential. Now connect this to deduct versus capitalize. If the cost is ordinary and necessary and it's a current operating cost, you generally deduct it now. But if it creates a benefit that extends beyond the current year, like starting up the business, forming an entity, or acquiring long-lived property, you usually capitalize it and recover it later. Exam tip. If you see creates future benefit, your brain should whisper, capitalize. Marisol is a self-employed midwife with a home office. Her principal place of business is her home, but she rarely meets clients there. Instead, she goes to clients' homes to perform her services on site. Which statement is correct? Options include, she can't deduct the round-trip travel from home office to clients. She doesn't have a qualified home office. She can deduct the round-trip travel, or none of the above. Think about it. The correct answer is that she can deduct the cost of round-trip transportation between her home office and her clients' homes. If her home office qualifies as her principal place of business, then travel from that office to client locations is business transportation between work locations. The tempting wrong choice is the one treating it like non-deductible commuting, but commuting is home to a regular work location, not home office to clients when the home office is the principal place of business. Harborview Foods Corporation opened on May 10, 2023, and incurred $53,000 of organizational costs in its first year. How should these costs be treated? Choices include deduct $2,000 and amortize the rest over 180 months, deduct $5,000 and amortize the rest, deduct only in the year before business starts, or amortize all of it. Think about it. The correct answer is $2,000 can be deducted currently, and the remaining $51,000 is amortized over 180 months. A corporation can elect up to a $5,000 immediate deduction, but it's reduced dollar for dollar when total organizational costs exceed $50,000. Here, costs exceed by $3,000, so $5,000 minus $3,000 equals a $2,000 deduction. The tempting wrong answer is the flat $5,000 deduction, ignoring the phase-out.